This is the WealthNet Market Call of the Week, highlighting investment trends that could affect your wealth. Globally aware with a geopolitical and quantitative perspective.
Hello, this is Llanes with WealthNet Investments, and this is the Market Call of the Week. Today is September 6th, 2018. I'm excited about what I'm going to be talking about today because there's a lot of confusion out there. There's a lot of strategies that people talk about, and you always, hear strategies from different people. And one of our processes here at WealthNet is to not just listen to what people say and just take it for what it's worth at face value, but to actually look at the facts and to test things out. And what I'm going to be talking about a little bit today is what it means when the market is at new highs and what does it mean to buy stocks that are at new highs. The reason why I'm bringing this up is because we're at new highs right now in the market, and many people are concerned that the market is, overbought and that maybe things are going to turn around. So what I wanted to do is just, first of all, let's just look at the facts of what the markets do when you have new highs and what happens with stocks that are hitting new highs versus those that have come down a lot and that are now starting to come up. There really is two competing thoughts and frameworks in Wall Street. One of them is follow the trend. The trend is your friend until it bends at the end, and you want to buy new highs. And there's a lot of people that follow that momentum type strategy. And then the other is, and the other strategy that I hear this a lot with my friends who are in the value business, that you want to buy those fallen angels, the ones that have gone down 50% or more, the ones that are looking good from a value standpoint. So what I'm going to do is I'm going to show you guys what we're going to do is we're going to look at 4 market cycles. And these are most recent bull markets and bear markets that we've seen. So what we're going to do is we're going to test from March 24th, 2000 to March 8th, 2013. And the reason why I want to test these periods is because it includes 2 bull markets and 2 bear markets, and they were very extreme. And that gives us the ability to see how the markets have reacted in those circumstances. So this chart here shows you the bull and bear markets, and you can see these markets were extremely volatile. We hit a high in March, and then it came down. It was at 1527 on the S&P, and it came down really strong down to October 4th, down to 800. That was a big move, and then it rallied big, and then it came back down. But in general, if you look at that whole period from that high that hit in March of 2000, we never really made any further progress. So I want to show what happens with new highs and buying stocks that are beaten down during both bull and bear markets and shed some light on that. In the next chart here, what you see is I wanted to point out that when we were doing our testing, we tested these signals and we wanted to make sure that we were not biasing our data. So what we did is we took out all the survivorship bias problems. We took out and only looked at the historical constituents of the market. And the reason why that's important is because you can have stocks that went out of business, companies that did poorly, mergers, acquisitions, lots of things like that. And we wanted to test that with what really was able to be traded during that time frame. The other thing that we did is we looked at a benchmark of an equal weighted index. And the reason why we did that is because many people don't realize this, but a equal weighted index means you put the same amount of money in each stock that you own. That inherently actually has an upward bias relative to the S&P 500. In other words, the equal weighted index tends to outperform the market. And so I wanted to actually show all of our results relative to an equal weight. So this chart here shows on the top the S&P 500 that's market cap weighted, the normal one that you see on the news, and the one on the bottom shows the equal weight. And you can see over the test period between those 2 vertical lines that it actually had an upward bias during that period of time. So what we're benchmarking to is something that actually outperformed the market. Okay, so what this chart shows is the bear market signals that we tested hitting new highs. And what you could see, the first part of it shows that this bear market was from March 2000 through October 2002. We'll call that bear market 1. And then bear market 2 is the one that was from October 2007 to March 2009, okay? So that first part is bear market 1, second part is bear market 2. And we're going to be consistent with that in terms of bull market 1, bear market 1, etc. So what we did was we did a test where we took the stocks that were getting within 5% of their high, and then we bought them. And we bought them and we held them for a year, and we analyzed what happened over that year. And we did a lot of statistics on them. So the statistics show the mean return or the average return, the median return, the percentage of gain, like the probability of having a gainer over the year. And then we looked at the distribution, the 80th percentile, like, the ones that went really up and then the ones that went really down, the 20th percentile. So we can look at the risk. We also looked at the range of it. So what we did was we compared the 5% from high, so those that were within 5% of their highs, and we bought those, and we compared that to those that we bought that were within 50% of the high. So in other words, they were down 50% from the high, and then they started moving upward, and they crossed over that 50% line. So what I did was I put a column on the right there that actually shows an interpretation comparing the two. When it says better, it means that the one that it's better, the 5% stocks are doing better than the 50% stocks. So what you could see in the bear market one was that most statistics were better. The mean return was better, the median return was better, the probability of gain was better, the 80th percentile was better, the 20th percent, everything was better. And what's interesting is the same thing we saw in bear market two. So what this suggests is that during bear markets, buying stocks that are closer to the highs is smart, and that you generally have a better outcome statistically. So let's move to this next chart, which shows the distribution of the different signals. So what the distribution shows, it's kind of like the old Gaussian curve, the curve you learned in statistics. And what we want to look for here is we want to look to see we want to find distributions that have relative peakness, so they have good kurtosis, and we also want to see that they have more tighter ranges and that they're not spread out. And what we see, the two graphs that are on the left are the 5% from high signals, and the two on the right are the 50% from high signals. And if you just visually look at those, you can easily see that the 5% from high has a much more concentrated distribution, and it's not sporadic. And the 50% from high has a very, very wide distribution, suggesting that there's a lot of risk in buying stocks that are in that 50%, that are off 50% from their high. And that's really what we see in real time, that the fallen angels, so to speak, really contain a tremendous amount of risk. And statistically, that's what we're working with. Now let's take a look and turn around and look at the bull market signals. We're going to keep it consistent. We'll look at bull market one and bull market two. And during bull market one, what you'll notice is that buying highs actually was worse than buying the stocks that were down 50%. And really, this makes a lot of sense logically, because when the economy is actually doing better, a lot of those companies that were selling off and that were really not doing well now are starting to come back to life. You'll see the cyclical companies come back to life. You'll see the companies that have had problems now being able to get financing and deal with their problems and repair their balance sheet, and they can have big upward movements. Now, with that said, there's still a lot of risk with those, and I'm going to get into that in a little bit. Okay, in bull market two, what we see in bull market two is that the mean return in the 5% from high signals was better than the 50% from high. But the median was actually better from the 50% high. And then the probability of gain was bigger and in the 50% from the high. So it's not as conclusive in bull market two that buying highs outperforms. And this is something that I'm seeing consistently with the data, is that buying new highs doesn't necessarily mean that those stocks are going to outperform during a bull market. It really is signaling more of keeping you out of stocks that are likely to have large corrections. And so its real value is more in that realm. And then later on down the line, I'm going to show kind of day by day what happens after you buy new highs. Okay, so now let's look at the statistics from the distributions again. And what you see in the bull markets here is the same phenomenon. In the bull markets, you still see this really wide distribution, suggesting that it's not reliable to buy stocks that are 50% off their high. It's dangerous. Even in bull markets, it's dangerous. Something really, really important to see. And on the left side, you see the stocks 5% from the high. A year after you buy them, they tend to have a tighter pattern of returns, and they may not necessarily outperform the market, but you don't have as many sporadic large downdrafts statistically. So on this chart here, this chart actually shows what happens when you buy new highs, and it looks at I'm looking at the entire range now. I'm looking at bulls and bear markets throughout the whole thing, just to see what the general tendency is. And what that red line is that red line shows how much the basket of stocks that are getting the signals are outperforming or underperforming the market. If it's above zero, it's outperforming. If it's below zero, it's underperforming. And what the green line is that the green line is the signal line. That's showing you the results from the signal, and it's got some bands around it to show the confidence of it. So, and you can see that really right after you hit new highs, there's a tendency for mean reversion where the stocks generally in the short term, as days go on, they tend to underperform, but then they start to outperform later all the way up to about 130 to 140 trading days. That's really important to understand because a lot of times when you're trading these highs, you have an opportunity where you can buy them on pullbacks, and that is a valid strategy based on this chart and based on this statistics that we've seen in this time frame. And the other thing to point out is that it does keep up with the market fairly well within the confidence bands all the way out to almost a year. But however, it does have a tendency to have a decay factor. The longer these new highs have been going on, the more chance are that you can start underperforming. So you don't want to be buying new high after new high after new high. And that's one of the reasons why when we do technical analysis, what we always explain is that you don't want to buy multiple highs after this a stock has based multiple times and gone up a lot in a bull market. So that's really important to understand. Now this next chart is just really kind of summarizing the long positions across the board, and this might look a little bit confusing, but basically what it's showing is that these distributions on the bottom two are very wide when you try to buy these 50% droppers. I mean, you really are dealing with a lot of risk with those. And then if you're buying new highs, you have a tighter return pattern, but that doesn't necessarily mean you're going to outperform the market. So let's summarize here. Buying highs beats buying lows in bear markets. That's what the statistics show here. Another thing is that buying lows is dangerous and can lead to significant losses, especially in bear markets like the financial crisis or even just a regular old bear market. Buying lows is a high risk, high return strategy. It requires more bottom up analysis, really understanding your companies. It requires smaller position sizes. You don't want to have too big a position size that increases your risk. And you want to have much more diversification when you're doing that. Buying highs has a tighter distribution with less large losses, but it doesn't always beat the market. There has been a tendency for mean reversion in the short term after highs, but outperformance in the intermediate term when you buy highs. On a rolling basis, when you buy highs, you tend to beat the market to about 140 trading days. Really, the bottom line is you can make money in both a fallen angel and a trend is your friend type strategy. Neither is superior at all times, but what is very, very certain is that it's a higher risk strategy to try to buy those beaten down stocks. Okay, that's all for now. This is Llanes with WealthNet Investments signing off, and hope you guys have a great weekend. Happy trading and investing.
If you like this information, be sure to subscribe and follow us on Twitter and Facebook. The market calls are designed for informational purposes and should not be considered investment advice. As always, do your homework, assess the risk, and invest in light of your personal goals.